Like and subscribe to my channel and click the bell icon to get new video updates.
Analysis Money Doesnt make America's economy work first. The money supply is just one of many factors affecting the U.S. economy, and its connection to actual outcomes has always been very tenuous. Also, people's willingness to borrow and financial institutions' willingness to lend play a role. The circulation of money, its speed depends on the actions of a multitude of financial intermediaries and their customers, of which banks are only a small part. This is reflected in the famous equation MV equals PQ, where M is money V is velocity, and P and Q are price and quantity of economic output. Second, the Fed's monetary policy changed fundamentally in 2008, when Congress gave it the power to pay interest on the reserves banks hold at the central bank. The move severed the link between the level of bank reserves, which are the key determinant of money supply, and the price of credit. When the Fed sets the interest rate on reserves at 5%, banks have no reason to lend less, no matter how much reserves they have. Because of this, despite the Fed's quantitative easing programs, inflation did not rise in 2009-14 and 2020-2021, despite bank reserve and money supply growth peaking at more than $4 trillion, or 26.9%. And now, the fact that banks are awash with reserves and liquidity will also soften the impact of the Fed's quantitative tightening. One reason they've been so slow to raise interest rates on customer deposits is so they don't need to attract more money to fund their lending. So where did inflation come from? The economy overheated for a number of reasons. Shifts in the composition of demand towards commodities in the early stages of the pandemic created chaos in the supply chain. Fiscal stimulus boosted purchasing power, and the Fed kept interest rates too low for too long.